Doing? Any big weekend plans out there? Quiet chat today. I'm not seeing a lot of not seeing a lot of action. You guys there?
I'm currently watching Meta. It was looking really good for me yesterday at the Open. Today, it's right in the middle of where I need it to be.
Where'd you need? I
Yeah,
forget
Jeffrey,
your
back from
number
the
on it.
neighbors. Internet's back. I'm getting a new internet provider today at noon, so in 2 hours.
What do you need? 645 on Meta?
6:45. Yep.
Yeah, I think you got a decent shot there.
I need it just to break even on the day.
Yeah.
That would be great.
Yep. Hey, Hank, CB, Jeffrey, hello. Susan, hi. How's everyone doing? Mohammed, Jackie. Yeah. What do you need? Like a 0.3% move from
From
here?
here, yeah,
Yeah.
I need a 0% move or better on the day.
Yeah.
Gonna
That's
make
that's
over
not a
over
whole lot to
100%.
ask. Not a whole lot to ask, I would say.
And it's moving. It's moving. Well, how's everybody's week been?
Janice, Michael, hello. Lee, hello.
Bit of a all over the place kind of week
Oh, for sure.
coming off the long weekend and the positive weekend news, and we've regained or we've given up all of those gains here this week. So we're pretty much flat on the week.
Yeah. We were probably due for a couple flat weeks, I guess, after you know, the kind of craziness of the last 6 weeks or so. For me, I think we talked about this a couple weeks ago. Really, anything that's not aggressively bearish, I'm still taking as a win as far as moving back toward all-time highs. I think, couple, 1-2%, slightly down, corrective days, but staying above the floor, still relatively positive as far as I'm concerned. We'll see what happens, obviously, but and I think we are at a little bit of a decision point now with how quickly the news got rejected. I'll mention that in a moment. Actually, this chart right here, I think we kind of do need to make a decision from there. But I think with that news coming out and then getting rejected and just kind of hanging tight, it feels like more of a pause right now to me than some rejection of this big rally. And so sticking with my prediction, I think Graham's as well, that we're kind of in an aggressive squeeze territory right now, looking for reasons to be optimistic. Kind of shaking off some of the bad news we've got. I think the economic realities and the market are pretty far detached right now. I talked about that on the round table. And so I do think that has to come home to roost at some point, but that could be 6 months, a year, 2 years before you really have to pay the piper. We saw that, many times, including 2008.
Yeah.
Hey, Dave, Gene, Michael, hello. Michael says rainy. It's been rainy here the last little while, but yesterday was a little bit nicer. So hoping for a nice, clean, clear weekend. Babette, good morning. Hello. Let me see. I think I missed a chat.
We
Oh, you were responding to Marianne about sitting poolside and hanging out. Well, that is a good way to spend a Friday. All right, folks. Well, thanks for being here. We got quite a bit to cover today. I got a free trade idea I want to share with you. I'm going to talk quickly about the market, where it's at, where I think some things are headed. I've got a debit spread training queued up here for you today because that's still probably one of the things that I get the most questions on. Is kind of the why I trade debit spreads or some of the finer notes on how they work, or how you can construct them. And then what I want to do is I want to kind of demo that out for you guys. Go to the charts, go to the calculator, and work through some of those different trade scenarios because I think that's the best way to really understand this. And honestly, for me, as I'll talk about today, one of the really significant benefits of a debit spread isn't just like time decay and some of the stuff we'll talk about, but it really gives you the freedom to structure trades in so many different ways. But really, you have to start to understand the risk reward, and how they work before you can take full advantage of that. So what I want to do is walk you through some of the kind of the basics of that. some of the the simple math and risk reward behind that, and then we'll go to the charts. I'll let you guys give me some trades and some concepts, and we'll kind of work through how those trade structures work and what the risk reward is. I think that'll be really helpful for you guys just to see it in real time with a real use case. Maybe we'll even put one of those trades on live if we really like one. If someone finds a good one, could even put one of those on live. And then I'll give you guys one more shot at today's official weekend option trade, which I'm excited about because we're hitting that 100% win rate. And obviously, I want to keep that rolling. So with that, thanks everyone. Hey, Carlos. Hey, Samuel. Faith. Hello. Let's go ahead and get rolling. So first things first, as I just mentioned, I do think we're at a little bit of a decision point. This is where we're at. This is the S&P 500. We had obviously an incredible rally here. We're at our first consolidation that we've seen since this week here. I think this is like, what would that be? April 7th there. So this is like April 15 or so, April 16 here. Really our first consolidation since that time over the last 3 weeks, making really net no ground from that initial weekend burst 2 weekends ago. And so I do think that we're at a point now where the market has to decide, are we going to come back? Are we going to come back and kind of fill this gap here and actually have like a corrective consolidation? Or are we just going to go sideways and then make our rip higher? I don't have a strong indication of which one those are going to be. I'm just going to try to let price action lead the way there. But I'm still pretty aggressively bullish here. Even as we've seen a little bit of shake, we saw that news get rejected. I still think odds are there's enough risk on appetite right now and enough, kind of news and highlights that we've seen stay for the back pocket of, tariffs being, the pause being extended and obviously the court ruling and things like that, that I'm still fairly optimistic. One of the reasons I'm optimistic is just that we have so much opportunity, in my opinion, left here in the sector. So for example, this is kind of that corrective nature since this is like from the highs here to where we are now. And you can see nothing really getting beat up a whole lot. Energy is the one that's being beat up the most. And frankly, that's even a little bit misleading because most of the big nuclear gains are not shown here inside of XLE, and they've had some really nice gains over the last couple of weeks. So most of the sectors are kind of huddled together. We're not seeing, technology or communications get really beat up and move us lower. And on top of that, we have things like some of the nuclear stuff inside of industrials that has more potential to push us higher. We have some of the stuff in technology like Apple that's still struggling way behind, and with the pop could start leading the, some of the recovery here. Honestly, even defensive and utilities and things like that. Like there's so many things that inside here have kind of what I would call held serve. They've taken a small correction, but they're still in decent position to move toward all-time highs. Financials in that as well. So nothing in the sector rotations makes me think, hey, we're getting, a leading sector moving us lower. Then you combine that with the fact that gold is still getting liquidity pulled out of it and arguably move toward more risk on assets, that I think that we're more likely to see, a quicker move back after this consolidation than a deeper 4, 5, 6 week consolidation, just based on what we know so far. Now, one thing, and Graham mentioned that, is the put to call ratio, which I'll talk about in a minute. But the other thing, the more bullish side for me, is that we really still have not seen insider buying pick back up. So we're still seeing insider buying really at, kind of the lower levels it's been for over a year now. And what that means is that there's still a lot of liquidity left on the sidelines that we could see enter the market. And if that does start entering the market, we're going to see that, propel the market much higher. And keep in mind, this is really just a timing thing. In other words, if the market corrects lower, then yes, we'll see insiders stay on the sidelines. But if the market just keeps moving higher, they cannot stay on the sidelines. They can't see this market go up net on the year 5, 8, 10%, which is what it would do if it shot past the highs, and just keep billions and trillions of dollars on the sidelines. Their investors are not going to accept that, and so they are going to kind of be forced to get back into the market at a certain point here. And if that happens, we could see, one thing lead to another, and then that push a squeeze higher and higher. So I think this is still kind of an ace up the sleeve, so to speak, for the overall market. That if we get insiders stepping back in, it could shoot us past the highs. Now, put to call is one of the more concerning signs that I think we saw. Graham mentioned this a little while ago. We got that ratio going pretty low. And as we've seen in the past, when you get that ratio, we do tend to see corrections. You see it here, obviously, the big November correction. And, it's pretty common here before April, although I would argue that really has nothing to do with sentiment. That was just pure news driven correction, but it happens to coincide as it often does. And now we're at the pretty deep levels here, which I think a lot of people have said, okay, that means we do need a much deeper correction. And that's possible. I mean, when you get risk on and you get retail, certainly possible that we need a deeper correction. And this is in the last 2 years. But one thing I want to show you guys is just making sure that you add a lot of context to your thought process before jumping the gun. Like this chart, I don't know about you. Give me a yes in the chat. This chart right here makes me think, oh, yikes, we're headed down. Anyone else, like immediately your gut reaction is, wow, we're at deeper levels than we've been. We saw the November correction on the S&P happen at a lower level. We saw it happen again here in July and August at a lower level. And we're now more overextended even than here, or about the same, where we saw it go. So this makes me think, crap, we are too overextended. There is too much dumb money, and we're due for another flush. I mean, at least for me, that's my gut reaction. Sorry, let me clarify. The red line is the actual S&P. This is actually what the market's doing, and the blue line is the put to call. Sorry, I should have said that at the beginning. So the blue line is telling you that the put to call ratio is very negative. In other words, too many calls relative to puts. And when that happens, you see the red line, which is the actual market, correct. Okay. But simply by going from the 2-year to the 3-year, it all of a sudden says, wait a minute, maybe I'm just a little too zoomed in here. And actually, we've seen lots of times where retail traders got extended and the market actually ripped and squeezed higher. So really important just to make sure you add enough context when you start seeing, could be a cool snapshot on Twitter and your mind says, uh-oh, bail, get on the sidelines. Just make sure that you add enough context. And so for me, yes, this is at a little bit extreme ranges, but we're already starting to correct on that. And if you take into account just a little bit deeper analysis, you can see we've seen the market squeeze much further. Okay, so interesting there. Sorry, I said 3-year. I should have said 5-year. Let me correct myself. Thank you for those of you in the chat. 2-year to 5-year is what I meant to say there. And this goes back and includes COVID, where people got extreme on the put side and the market just kept squeezing higher. In 2022, the put to call was lower and we saw that correction. And then we saw, by the way, it get really extreme here in the middle of 2023. But by the way, this was before we topped out, not after, which means that the market actually had more room to go. Okay, so the put to call ratio for Stacy and those of you asking, it's typically used as basically a dumb money indicator. So that, when retail and people get too aggressive buying calls, it normally will result in a flush of the market that takes out that money. And we do see that generally speaking, but it's not a perfect indicator. Sometimes when you see like a year snapshot, it'll make you believe, hey, this has to happen. But just by zooming out a little bit and adding some context, you can often see, okay, actually, there is still oftentimes plenty of room for the market to squeeze to all-time highs, even in that situation. So again, just overall, I do think that we're a little bit extreme, but I don't think that stops this market from making a squeeze up to all-time highs before correcting some of that back out. One of the things that I find super interesting about the market is that we used to have to time up risk on assets for bull runs. What do I mean by that? It used to be that if you want to trade like the high growth stocks, or you wanted to trade like the most aggressive names, today in today's day and age, that might be like Palantir or MSTR or something like that, that you would have to trade, the boring stocks when the market was good or medium, and then trade like the risk on assets when we were really going higher. And I think that since April 7th, when we've been ripping, It's a good example of that. Like I shared recently, the mags is certainly outperforming anything else, up 27%, literally over twice what IWM and the SPY have done. And what's interesting is that if you go back, we're actually seeing these quote unquote risk on assets, even though they have deeper corrections, perform better net overall. So here's if you go back a little bit further, okay? So this is taking into account the last year. Even with the deeper correction, the mags are outperforming the SPY by about 2-to-1 risk to reward. So again, what people would have said maybe 10 years ago is, yeah, sure, NVIDIA and Meta and Apple, they're great when the market's ripping. But when you have one of these corrections, like we just saw one of the deepest ones, then you're going to wish that you were just holding the SPY, or you're going to wish that you were just holding dividend stocks. What's interesting is that even when you account for those flushes, we're still seeing the Mag 7 and the risk on assets outperform. If you go back even further, we're seeing that even more hold up. This is since the invention of the MAGS, ticker MAGS, which is early 2023. And you can see, even with the August flush we had in 2024, the April 2nd flush we've had now, look at how much the MAG 7 is outperforming the rest of the market, specifically IWM, which Graham and I had mentioned. We keep waiting for IWM to catch up, the small caps. Still hasn't done it for us. And to me, that might just be the generation of investing that we're in right now, to be honest. That might be a decade or 2 decade long trend that we're in right now. So I think this is really interesting. Yes, the corrections, like you see here, are deeper on the Mag 7 than they are in the SPY. But net, look at the gap we've created in the Mag 7 compared to the SPY, even when you account for those corrections. So in other words, we're not just cherry picking the bullish runs. We're saying even when you account for those corrections, like these really steep corrections, the gap is really significant. And so I guess my question for everyone would be, do we see this slowing down? And what good answer could you give for the Mag 7 slowing down relative to taking over the rest of the market? Because right now, I don't really see a scenario outside of some, very extreme ones where the Mag 7 stops dominating really everything else. I mean, think about it. If you get a very regulatory situation come in from a government body, the Mag 7 are going to do great in that environment. Why? Because they can withstand regulation, taxes, and everything else so much better than everyone else. They have the capital, they have the resources, they have all of the people in Washington, D.C. to make those deals. So in a very intensive regulatory environment, the Mag 7 should dominate everyone else. And in a very free market environment, guess what? The Mag 7 should really dominate everyone else because they're going to acquire, they're going to use their resources, they're going to be able to take the risk on situations that, like other companies can't take with research and development, like what Microsoft did with OpenAI. And so in a more free market environment, they really have a huge advantage as well. Let's say that you totally open up free trade and you're bringing back more manufacturing from China, Taiwan, Mexico. Well, the Mag 7 are going to make the best deals. Let's say you totally restrict that and you have to produce it in the US and there's no free trade with China, Taiwan, and Mexico. Well, the Mag 7 are going to be able to resource that most effectively. So I'm just giving you kind of those extreme examples to show I really personally don't see in the short term, medium term, this situation slowing down where the Mag 7 just has the upper hand and the advantage of taking more market share in most scenarios. And so one of the trades that I like is the Mag 7 MAGS call debit spread and an IWM put debit spread. And so what this trade looks like is basically you're doing calls on the mags where you say, listen, if they continue going up, anything above current price is going to pay me money. And the IWM side is anything that goes lower than current price is going to pay me money. And you can do this over a 1 week, a 2 week, or a 6 month time frame. And for me, the trade idea is the same regardless of how aggressive you want to be from timeline. You want to be bullish on the mags and you want to be bearish on IWM. Now, the cool thing about this is it's kind of like a pair trade. Two separate trades, but it kind of acts as a pair trade. If the market is aggressively bullish, you're almost certainly going to win on the mag side. Because if the market goes up, you're almost certainly going to see bullish follow through and make money on this trade. And if the market collapses, you're almost certainly going to see the IWM go down and you're going to make money on the put debit spread. So there's very, very, very few scenarios where you're not going to win, at least on one side. And so if you set it up where, it can make you like around 100%, then you're pretty darn well hedged where you're not going to lose money. Again, there are certain scenarios where you could. MAG starts underperforming, IWM starts overperforming. Obviously, that's possible. But in the vast majority of circumstances, you're kind of protected where you're going to win on one side or the other. And if we see a continuation of what we've seen lately, then you can win on both sides. So this is kind of a cool trade idea where most scenarios you're hedged and you get a win out of it or a small net win. But in some scenarios, you can get a double win, which I think is really cool. So cool trade idea here using a debit spread. And this kind of leads into why I like debit spreads, among many other reasons, is just these different trade scenarios. So what I'm going to do is I'm going to go into our debit spread training now. And if there are trade ideas like that one that you like or other stocks, toward the end, we're going to actually go through and play some different trade scenarios, which I'm hoping will give you guys, kind of a light bulb moment of how to understand risk to reward and apply it in different trades. Okay, so let's jump into the debit spread training today. Now, most of you already know I love debit spreads and I use them in almost all of my strategies. The question is, why? Why would I use a quote unquote more complex, although I don't even believe that, but quote unquote more complex trade structure in almost every trade I make? So today I'm going to break down the benefits, how they work in real time, and some common questions I get about them. And then, like I said, we'll do an exercise at the end that I think will be a lot of fun. For just a quick review of what a debit spread is. So a debit spread is buying and selling an option on the same asset with the same expiration date where the option you buy is more expensive than the one you sell. That's what a debit spread is. So an example is you might buy a 205 call, you might buy the 200 call, sell a 205 call. The one you buy is a little more expensive, and then you have a net leftover cost. Anytime you still have a net leftover cost because the one you're buying is more expensive than the one you're selling, that's a debit spread because you still have to pay a debit. Now, why do I love this trade structure? Because they overcome the two most common problems traders face when buying regular calls or puts, which is what most people do. I mean, you guys can let me know in the chat if you're an opening playbook, you might not fall into this category, but 90% of traders fall into this category where the only options trades they've ever made are buying a call or buying a put. Someone give me a yes in the chat if that's you. If the only option trade you've ever made is either buying a call or buying a put. You've never done a debit spread, a credit spread, a covered call, an iron condor. Shoot me a yes if that's you. Oh, wow. Even in our group, there's a ton of yeses. That's amazing. So even the opening playbook folks. All right, well, I love it. Keep giving me a yes if that's you. Great. I'm glad you're here because I'm hopefully going to give you a little bit of an aha moment here with trading a different style. So most people know the number one problem with regular calls and puts: time decay. That's number one, which kills the value of regular options unless the stock is moving directly in our favor aggressively. And the more aggressive you want to be, think like an out of the money option where you want to go for a big win, the worse time decay is going to beat you up. Now, one thing that I always tell people they maybe don't realize is, let's say that you buy a call option here and price starts going up in your favor immediately. That's your best case scenario for a call option because you're getting value right out of the gate. And let's say that your option goes up and now you're up 50% in the first day. What a lot of people don't realize is even if the stock doesn't come back down, it just goes sideways for a few days, this value is already going to start to come down. Day 2, you're going to be up 40%, and day 3, you're going to be up 30%. So even when the stock does go up immediately in your favor, if it doesn't keep going up in your favor, you start losing money even in that situation, which is kind of crazy, I think, if you ask me. But it's one of the things people don't always realize. It goes up in your favor, you get off to a head start, but it has to keep going in your favor every single day, or you're going to start to lose value on the call option, even if the stock itself isn't losing value. Okay, then we have problem number 2. This is the expected move baked into the option price, meaning, yes, you can buy an option. It's going to have a certain, time decay associated based on how far out it is and how much time is on the trade, but you also have this expected move. And this is the part most folks don't even realize they're trading against. So, for example, you buy a 245 trade here. Okay, so you buy 245. The price to get to break even is 247.50. That's crazy. You have to get $2 above the price just to start getting in. 240, 243. Okay, so here, this is probably the most important number, and most people don't even know that they're trading it. If you buy a 245 out of the money call, in this case on Apple, you need a 9% move in the stock just to break even. Even if you buy a more conservative option closer to current price, you need a 4 or 5% move just to break even. Okay, so most people don't even realize they're trading against this break even price, which I call the expected move or the market maker move. And that is a really big hurdle for most people to overcome. So a debit spread counteracts both of these challenges organically just based on the trade structure. And I'll give you an example here at the end as we go through our demo. For now, just understand that we counteract the time decay because we are selling an option at the same time we're buying one. Okay, so we're selling the option as we're buying it, which helps us counteract time decay. And we completely eliminate the expected move because with a debit spread, we choose our own exact line in the sand that we're trading. So we're not trading against some unknown higher price. We're trading our own price that we choose, what I call the line in the sand, on every debit spread that we make. And that line in the sand creates an even bigger advantage for debit spreads because you can use them to construct trades in a way that you simply cannot do with regular options. Okay, so it's not just that they're quote unquote better or they get to profit more easily. You can create trade scenarios that you simply cannot trade with regular options. For example, let's say I think Apple is going to go up over the next month, but it's not necessarily going to explode higher, right? It's just going to grind up a little bit. Well, regular options literally can't help me, which is kind of funny because that's probably the most common scenario for trading a stock, right? It's going to go up a little bit because stocks go up more over time, but it's not necessarily going to explode higher. Probably the most common scenario for a stock, and yet regular options are going to make you lose in that scenario. Here's the example of Apple. I pulled it this morning with 28 days till expiration. If I want to trade Apple for $200 over the next 27 days, right? Just a small 1.5% move over the next month. I literally cannot trade that with regular call options. Why? Because my break even on a 200 call option over the next 28 days is $207. Right? So I need a 3, 4, 5% move just to break even over the next 28 days. Think about that, guys. That's an annualized, if you go with a 4% move, that's an annualized 50% return on Apple in the year. Now, Apple's a great stock. Sometimes it does go up 50% a year. But I don't know about you. I don't really want to trade in a scenario that requires me to nail 50% annualized returns on Apple. But that's the situation with regular calls. And if Apple goes up 5% in 1 month, a 60% annualized return, then I can make about a 40% ROI on that option. Not a very big payoff for nailing the time and direction of a 5% stock move. I don't know about you guys, but if I nail a call option on perfect timing where the stock goes up 5% over the next 28 days, I want to make a lot more than 48%. I just don't think that's a very good payoff for perfectly nailing time and direction on a 5% move. But with the debit spread, I can very easily construct a trade that fits my view. I can do it like this. Buy the 195, sell the 200. Now I'm actually trading for that $200 number instead of some mysterious higher break-even price. And the total cost on that is about $320. So, less than half of the cost of the regular call option. And in this scenario, I can generate about a 56% ROI on Apple over the next month for less than the 1% move. Okay, so on the same stock, over the same time horizon, here's what we have. Regular call option, Apple moves 5% up, generates a 40% ROI with more total risk. versus Apple moves 0.5% up, 1/10 the move, generates 54% ROI with less total risk. Okay, so those are the two scenarios we're playing out here. On the regular call, you need 10 times the move to make less money. On the debit spread, you need 1/10 move to make more money. And by the way, you can trade it for less total risk because the total cost is less. Pretty crazy, in my opinion. And that's just one way that you can use them. You can also set up defensive trades like we do with Income Machine. We can use an example of that when we get into the charts here in a moment. That's trading for less than the price that the stock is right now, or incredible long-term risk-reward scenarios like we did in the Dream portfolio, if you guys remember. Okay, amazing scenarios by using debit spread versus the call options that would have been crazy expensive and had huge expected moves baked in to overcome. Or you could stack them like I taught in the Investing 2.0 Masterclass. That's a free masterclass I did in one of our opening playbook sessions, which is a great way to use debit spreads. There's so many different ways. But the key to leveraging all these scenarios, and the part that most people skip over when talking about spreads, is actually understanding the risk reward. In my opinion, this is really the key, because once you understand the different risk reward scenarios, you can now go into a chart and set up a trade you like and understand what you're actually putting on the line and for what potential. And this is really what bothers me about, like, trading gurus or quote unquote income trading. Sometimes they'll give you an entire presentation about like generating income with spreads, or making 10% a month, or whatever it is, and they'll literally never explain the risk reward. They'll never explain how the actual trade structure works. I don't know if you guys have ever seen those presentations. There's nothing wrong with trading for income or having those kind of 5, 10, 15% ROI trades, but you really have to understand the structure itself if you want to be able to use this to its full advantage and trade different scenarios like we're going to talk about here in just a minute when we go through some demos. So let me just walk you through how it works. It's actually pretty simple. It might take you a little while of doing it to get the light bulb moment. Hopefully, once again, our demo will give you that light bulb moment, but it's actually pretty simple. So here's how it works. The max value of a spread is determined by the width of the spread, meaning the difference in strike prices. It's always the same, okay? You don't have to do anything crazy. The max value of a spread is always, always, always determined by the width of the spread, or the differences in strike prices, okay? So if you buy a $99 call and you sell a $100 call, the width is $1. How do I know that? Because 99 and 100 are $1 apart, okay? So we know right out of the gate that $1 is the most that spread can ever be worth, no matter what, right? Right out of the gate, we know that $1 is the most value that spread can ever be worth. It can't be worth $1.50 because it's a $1 spread, right? If you buy a $2.50 call and you sell a $2.55 call, the width is now $5, right? Because the two strikes are $5 apart. And now we know that this spread can be worth a max of $5, and it can never, ever, ever be worth $6 because it's a $5 spread. Really important to understand that right out of the gate. So you should always know the max value of a spread instantly. You don't have to do any special calculations. Just subtract one from the other, and now you know your max value. And once you know that, you can understand everything else about your spread. So the max risk of a debit spread is whatever you pay for it. Okay, so if you pay 25 cents, that's your max risk. If you pay 75 cents, that's your max risk. Whatever you pay, remember it's a debit, so you're paying something, and whatever you pay is your max risk. Folks, it does not matter how wide the spread is when it comes to your risk. It only matters what you pay. Okay? Common misconception here as well, but it's actually very simple. It doesn't matter if you're trading a $5 spread or a $100 spread. Whatever you pay is your max risk. Okay? Everyone got that? I mean, again, it sounds simple, but this is like most people skip over this part. What you pay is your risk. Now, it does matter for your risk to reward, because your potential reward is going to be the max value of the spread minus what you paid. Okay, so your risk is your risk, but you have to understand your risk to reward ratio if you really want to get serious. So if you pay 50 cents on a $1 spread, your risk is 50 cents, and your potential reward is the value of the spread, $1, minus what you paid, which is what is left over now, equals 50 cents. So if you pay 50 cents on a $1 spread, that means you have 50-cent potential reward. And now your ROI potential is 100%. But if you paid 50 cents on a $5 spread, your risk is still 50 cents, and your potential reward is now $5 minus the 50 cents you paid, or 450, which would be a 900% ROI potential. Not bad, right? Wouldn't mind a, 900% ROI. But the point is, that's an extreme example. Your risk stayed the same. Whatever you paid is your risk, but determining your risk to reward is where the math comes into play. Okay, so that's the simple terms. Get your width, know what you paid. Now you've got a risk to reward scenario. So let's actually jump over to the calculator and the charts and run through some scenarios so you can actually see this in real time and give me some stocks you like. We can set up some actual different scenarios and run through what this looks like. And I'm hoping this gives you that light bulb moment of, oh, wow, I can set up any scenario I want. And as long as I start understanding this risk reward stuff, I can totally create these trade scenarios. So let's go ahead and do that. Here we are on Meta. Someone asked about Meta. Okay. Meta is trading at 645. Let's start creating some scenarios. Okay. Who wants to trade Meta aggressively? You want to go for a big directional move? Give me a yes. Who wants to trade Meta defensively? Type in no. You want to go underpriced and trade it defensively? Give me a no. We'll do this a couple times. If we get more no's, we'll look at the defensive. If we get more, okay, more no's. So we'll look at trading Meta defensively. Don't worry, we're going to do several examples. Okay, so let's go and look at Meta on the actual option chain, right? And let's say that we're going to give Meta 3 weeks. So we'll go to June 21 and we'll give Meta 3 weeks. Right now, Meta is trading at 646. Okay, so if we wanted to trade it defensively, we could go down and trade it at like 640, right? Because that's below the current price. And we could do that by going to the June 20, buying the 637.50, selling the 640. Now we're giving Meta $5 of room, or actually $6.61 of room based on where it is to come back. And we know that trade would cost us 148 or 150. Okay, moving around a little bit, but around 150. Now, like I said, okay, great. We can trade it for 150. What does that actually mean? Well, let's just do this really simply by going to our handy dandy calculator. All right. So if you go to the handy dandy calculator, you can just type in the numbers, right? So we're going to trade the 637.50. That's the one that we're going to buy. We're going to sell the 645, and I'll do 10 contracts. And I just told you it would cost you about $1.50. Well, now we know well, it wouldn't cost you $1.50 because I did 645 instead of 640. There we go. Now we know what our ROI numbers would be on this defensive trade. And by the way, the numbers are pretty darn good. We can make 67% on this trade as long as Meta doesn't come back $6. How do we know that we can make 67%? Well, we know the spread is $2.50 because the one we're buying is 637.50. The one we're selling is 640. We're paying 150. That leaves about $1 of potential left over because the max value is what? 640 minus 637, $2.50. That gives us 67 cents. Now, I just want to note for a second, you can't do this with a call option, folks. There is no call option you can buy, period, end of story, that says, hey, as long as Meta doesn't go down $6, I'm going to make 67%. That call option does not exist. You can only do it with the spread. Okay? So we just invented a trade scenario where Meta can come down $6, now about $7 over the next 3 weeks, and printed out the risk reward here just by knowing our options. Let's do a different one. Let's do Palantir. Someone mentioned Palantir. Oh, Palantir's looking good. Woo! Love Palantir. I actually have an income machine on this trade right now. Let's do Palantir more aggressive. Let's say we need Palantir to go to all-time highs right around 134. Okay. Go back to our option chain. Type in PLTR. How much time do you guys want to give it to go to all-time highs? You guys want to give it 1 week, 2 weeks, 4 weeks, 3 months? How much time for Palantir to go to all-time highs? Which is going to be about a 4 or 5% move. All right, 30 days. So we'll get it to the closest we can. June 27th, about 28 days. Okay. We're just inventing this trade scenario. We go up here to the 133, 134. Okay. Over the next 28 days, that trade is going to cost us about 33 cents. Okay. Let's go back to our calculator. Type it in. 133 is the one we're buying. 134 is the one we're selling. It's going to cost us 33 cents. We now know that we can make 203% on this trade. Okay, so we just did a defensive trade where we can make 67%. Then we create a totally different scenario on a different stock where we can make 203%. And the difference is, if we just do this very pragmatically, what you can see here is this one. If it'll let me put my number in, 134 is trading it for all-time highs. Okay. So this one is an aggressive trade where we're trading it where it has to break this line. Whereas Meta, we're using a more defensive trade in this 640 range. 640. Okay. And you guys see how we literally just invented the trade? We put a line in the sand wherever we wanted, and then we constructed a trade around it. We could have been more aggressive. We could have given it more time. We could have been less aggressive. Okay, let's do another one. Someone else give me another stock. I know there's a whole bunch posted, but now there's been too many chats that I missed them all. Whoever's the first thing I'll go to. All right, Mags. Perfect, because I actually said I wanted to trade Mags. All right, Mag 7. Got a little bounce back after the highs, but let's do one of Graham's wrap wars. Let's trade Mags right around where it's at right now. Go in here. Type Mags. Sorry, I'm getting a call. Let me decline that. Type in Mags. Let's give this one 2 weeks now, different time frame. And it's currently trading at 52.81. So let's wrap it. Now, here's a fun way that we can wrap it. We can actually do the 52.50. 53.50. So we're getting a pretty good wrap here on it. Oh, it doesn't have the 53.50. I'll have to do the 53. All right. So 53, 52.53. This is not a perfect wrap because Mags is up a little bit higher on the range. But you can see to do that trade is going to cost us about 60 cents for a Mag 7 wrap order. All right. Let's go to our calculator. 52. 53, going to cost us 60 cents. All right, now we can get about a 67% ROI for the Mags going up 20 cents. Pretty good. Not as good as Meta, by the way, where we can get a defensive trade for the same 67% ROI, but still pretty good. Why? Because a call option, we could never take this trade. There's no way to trade a $53 call option on the Mag 7 and make 67%. If Mags goes up only 20 cents on a on the Mag 7, we're going to lose money on the call option. Okay? So this is pretty cool. Can make 67%. But so far, I don't know about you guys. So far, I like the Meta trade the most because we can get a defensive trade that pays us about 67%. And this is what's so cool about understanding the risk to reward. You can play around with these scenarios and find trades that you really like. I actually do think Palantir over the next 4 weeks has a very good chance of going to all-time highs. So making 200% on that one, I like quite a bit as well. But I really like that Meta trade where we can be defensive and make about a 60+% ROI. Okay, let's do one more. Someone mentioned Tesla. Let's jump into Tesla. Also, one that you guys know I like right now and breaking to all-time high. So let's do a crazy one. Let's do Meta all-time highs, which, by the way, I gave this trade out on a roundtable about 2.5 months ago. And if you took it, you're up over 200% on that trade so far. But let's do it for fun anyway. And let's target all-time highs, $490 a share on Tesla by October. Okay, so we'll give it some time here. But let's say it's going to keep squeezing. So Tesla, then we go out all the way out here to October, and we scroll all the way down. We are going to have to add some strikes here. All the way down to those 490s. Here they are. 485, 490. Okay, $5 spread now. We can get in for about 80 cents. So go to our calculator. 480. Oops. Yeah, I keep 485. 490. That's an all-time trade, and we can get in for about 80 cents. This trade will pay us 525% ROI if we were to take that one. All right. So this is an extreme one, but we're giving it lots of time. Does everyone see how we can create all these different risk-reward scenarios if you understand a spread? Most of these trades you can never do with regular calls and puts. All right. Anyone, you guys want to do one more? We can do one more, maybe one more defensive one.
Nate, what do you think of Progressive right now?
Oh, Progressive, which has been the bane of my existence, is just float sideways here. But we can do a protective one on Progressive. Let's actually, instead of going to the chart, let's do all of our stuff, or instead of going to the trade in the brokerage, let's plan our trade on the chart and then go set up the trade. So what number do you guys want to use? Let's say that we want to do maybe 275. Pretty protective for Progressive, kind of underneath these lows. And then we could do, how much time do you want to give it to stay above 275? You guys want to do just like next week's candle is going to stay above this level? Or do you want to do it, 3 weeks, 4 weeks? What do you think, Graham? How much time do you think to give Progressive to stay above 275? If we only give it 1 week, it's probably not going to be as good of a risk reward, but a very high probability trade.
Yeah, I think they don't have earnings in June, no. Do they?
July. Not till July.
The June 20 option, the monthly ones have pretty good liquidity.
Yeah, July. All right, so we can give this a little bit of time and just have a defensive trade on Progressive. If we give it a box, basically we're giving it to here. Anything in this box will equal money on this trade. Give it 3 weeks, give it time. How do we do that? Go to Progressive, go out to the June 20 here. Let me just narrow down my strikes a bit so it's not too crazy. And we go to the 270. Or did I do 275? I already forget. 275. Go to the 275. All right. So this trade is a $2.50 spread that we can get for $1.80 or so. That's actually going to be pretty nice. Let's check this one out. This is going to be pretty nice. So this is going to be 272.50, 275, and we can get in for about $1.80. That's going to be a 39% ROI on Progressive, doing a whole lot of nothing except for not going back 2%. I like this one. I mean, it's not a huge ROI, but 39% for Progressive just to hang tight and battle above this 275 line. I think that's pretty darn good, especially because it's a relatively defensive stock in general. So we just invented a whole new trade idea on Progressive in real time by using a spread. Once again, a trade that you could never do with a regular call option. And folks, it's really all about trying to understand the math and then construct trades in a way that, you think have high probabilities or you like to be aggressive with, but you don't want to pay, $8,000 for an option. There's just so many different ways that you can use these kind of trades. Okay, so hopefully I achieved my goal and we had some light bulb moments there along the way of being able to do things with spreads that you really can't do with other things. And by the way, another cool thing, which I'm actually going to talk about here in a moment, is then you can take it a level further and you can actually set a target on a spread, which most people really never use, but I think is a great way to trade. So what you just saw is an example of how to structure trades in a way that gives you different risk-reward scenarios based on the actual trade structure. Okay. And hopefully that was really valuable because I think, again, most people don't actually go through the part of teaching you the risk to reward side of it. And we want to make sure that you guys are able to do that. Now, next, I want to walk you through what might be the single best scenario I have found from a risk reward versus win rate, which is the weekend trade that we've been doing with a 95% win rate. Okay, so that's the next thing on our agenda, which is your last chance at today's official weekend option trade. Okay, so this is kind of a perfect segue. Why am I able to take advantage of the weekends when most people are concerned about it or think it's high volatility or high risk? It's exactly what I just showed you guys. Using structure to take advantage of it and actually play volatility in our favor, I think is really what gives us the single best advantage. So hopefully you guys are able to take advantage of this in a whole new way, on your own trades, looking at your own scenarios. But for me, this weekend trade is probably the highlight of taking full advantage of that. All right, before we get started, of course, you guys know the drill. Anytime I'm going to talk to you about a strategy or my performance, all the good stuff. This is based on several years of data with, like I said, a 94% win rate, bumps up to about 95% once you account for our 5 for 5 live trade so far. Each trade, a couple $100 or so on average to put on, and around a 21% return on one of those more defensive trades. So I'm going to let Graham take it over from here to kind of intro this idea because he helped me put this research together. But this is probably, the highest confidence trade that we have right now, and it's using the same principles we just talked about.
Yeah, and it's a great one too. So far, undefeated on the live trades. No one can complain about that. So that's been really awesome to see. But kind of like what Nate just showed you guys, really, really high accuracy trade here with really great risk to reward. And it's all thanks to what you're seeing right here. So before we get going, I want you guys to take a close look at this redacted document. What you're looking at here is a special perk set up by the Chicago Board of Options Exchange just recently. It's a perk that now allows everyday folks to target extra income over the weekend, and that you can do that from any regular brokerage account. Now, I'm talking about payouts that the study shows were worth $1,030 on average in extra income each weekend. That means while the rest of the world is left empty-handed on Saturday and Sunday while the stock market is closed, we have an opportunity to target extra income over the weekend while still getting the most out of life. Like on August 9th, you could have taken a few minutes to place a quick trade before the weekend hit and maybe hit the lake for some weekend fun. I think that's my plan this weekend. And then came back Monday with an extra $1,052 sitting in the brokerage account. Then the next weekend came, August 16th, you could have set your trade, caught the classic car show over the weekend, and woke up Monday with a crisp 883 in weekend income just this last year. And a few days went by and you got a chance to do it again. Friday, August 23rd, hit a few buttons on the phone or laptop to get in before the weekend hits. Maybe play some golf with some friends, catch dinner and live music for the weekend, and brunch the next morning. And when Monday came, instead of dreading the start of the week, folks could have come back to a cool $1,090 in extra income sitting in your account on Monday morning. Now, before we get carried away, let me be the first person to say this. There's nothing guaranteed in the markets. There's no instant income magic pill. Just like with anything in the stock market, there's going to be winners and losers along the way. That's why for the next few minutes, I want you to forget about being the next overnight millionaire. Because financial freedom, it doesn't happen overnight. It happens bit by bit, weekend after weekend. And with what Nate is about to share with you today, well, our hope is that your weekends could be just a little more enjoyable, knowing that when Monday hits, we're out of the trade. So really, think about this. What if there was a way to target an extra $1,030 on average in extra income each and every weekend? All by taking a few minutes to set the position before the weekend hits and then clocking out on Monday. Well, thanks to a shocking discovery found inside this document by Nate, it is now possible. So welcome to our weekend options program here. Now, if you're new here, my name is Graham Lindman, and you might recognize me from my flagship strategy, the Perfect Apple Trade, which has reached over 100,000 people worldwide. Or maybe you've heard of my famous wrap orders, which has helped folks see doubles in their trading. Now, given my track record, I don't normally take trade recommendations from other people. But the premise of this new way of generating income over the weekend, it was so different that I had to explore it. I'm talking about a legal way to target extra cash over the weekend, while most folks out there are making zilch, not a nothing. So if you're looking for a way to target extra income to maybe pay for everyday expenses or just boost a retirement nest egg, then this may be perfect for you. Now, the man behind this new discovery is no rookie when it comes to the stock market. Not only did he publicly grow a $10,000 stake to north of $50,000 over the course of about 4 months, but he also earned another $100,000 last year in his investment and dividend portfolio alone, a really great return on this starting stake there. And over the last few years, he's been on a mission to help everyday folks tap into some of the same methods that have been kept away from the average Joe. And just hear some of the stories from folks following along with his weekend trade. They've been taking this trade. Cindy B took it, $1,200 in profit last weekend. Karen, a winner, as you know, made $1,230 over the weekend. Carl says Nate and his team are doing a tremendous job, up over $4,000. That's awesome. Now, those are some of the stories from students following along with none other than the up and coming trading icon, Nate Tucci. So, Nate, it's
Wow,
great to have you on
icon.
today and talk us
That's
through this.
I love it. Well, thanks for having me on to do this and everyone for tuning in and sticking with us here to talk about this weekend trade. And today, my hope is to empower you. I'm going to show you how, after just a few minutes of your time and a couple clicks inside your brokerage account, you could start targeting your very own weekend cash flow from the stock market. One that's shown the power to pay $1,030 on average in extra income each weekend we get an opportunity. And the timing for this new briefing couldn't be any better. I mean, we all know right now some of the hardest working folks have been getting killed by inflation over the last few years, which is why we've seen the average savings hit the lowest levels since 2008. Not a great time to be compared to. And even if you got a raise last year, probably doesn't feel like it makes much of a difference at the end of the day, which is quite sad for the average person. But thanks to inflation, we're seeing things like credit card debt hit all-time highs, $1.2 trillion in credit card debt. That's a crazy number, which has left folks looking anywhere they can to generate extra income to cover the bills. It's almost impossible to keep up with the ever rising cost of living, which we hear from our people in Opening Playbook every day talk about that. Most folks think that the only way to generate extra income is by picking up a second job at Costco or working overtime hours or late weekend nights. But with what I'm about to share, you can start targeting your very own weekend cash flow right from the comfort of your home, your sofa, your bedroom, in your underwear, whatever you want to do. And right now, everyone could use some extra cash flow. It doesn't matter if you have a multi-million dollar retirement account or just starting out with a couple $1,000s. All you need is a standard brokerage account, internet connection, and a few minutes to set the trade before the weekend. And in just a few minutes, I'm going to help you get started with your first chance at weekend cash flow. But before we get there, let me take a walk with you back to September of last year. So going into the month of September, the market took a horrible hit. If you invested $5,000, the amount I'll use for all of our examples today, at the beginning of September, you would have experienced a pretty brutal fall, and the buy and hold technique would have lost about $204 by the time the first week was over. But if folks would have been following the weekend cash flow method, they could have seen a very different story. While the S&P 500 was plummeting, you could have walked away with an extra $3,039 for the weekend. Then the next weekend rolled around, not much different. This was the weekend of September 16th. The broad market, gold, even Bitcoin were flat over the weekend, earning folks, like Graham said, a good old zilch over the weekend. But with what I'm going to share, that same weekend, you could have actually hit it out of the park. In this case, by Monday morning, you could have found another $803 in your account closed automatically.
Nate, that's awesome. And between those two trades alone, we're looking at $3,842 in extra income after 2 weekends. Now, I don't know about you, but to me, an extra $3,800 would be a meaningful chunk of change. Since the pandemic, the cost of living has gone skyward and it's out of control. In fact, with the spikes in interest rates, we've watched as the average cost of a new mortgage went from $1,400 a month all the way to $2,317 a month. That's crazy. That's nearly a $900 increase every
That's
single
like
month.
50%.
Yep. And it's not like people have a lot of extra change laying around to cover the difference either, not unless you're sitting on a pretty good nest egg to begin with. But folks who would have taken advantage of this weekend cash flow method could have more than covered the cost of the average monthly mortgage without needing to slave away at a desk job, working extra hours to make it happen. Instead, you could have done it all while enjoying life to the fullest over the weekend. And keep in mind, guys, that $3,842 after 2 trades would have come in while every major index, crypto, and even bonds were in the toilet. So, Nate, can you share a little bit more about how this is all possible?
Yeah, but first, let me just say this. If you have a job, obviously, I'm not telling you to quit it. I try to tell people that every time we talk about these strategies. If you've been steadily saving for retirement, please don't stop in my account. What I'm sharing with you is meant to be a way to supplement your income. Okay. It's not a go all in strategy. And it's a new technique that I really don't think anyone else has figured out. Now, if you're here right now, you probably are pretty smart. You probably know what I'm going to say next. That, like any investment strategy, there's risk. We expect to have winning weeks and losing weeks, which is why we worked extra hard to optimize the weekend cash flow method. Now, of course, no one can guarantee future returns, but when you account for all of the weekends so far from the study, winners and losers included, we're looking at what could have been an average of $1,030 in extra income each weekend we got an opportunity. Just like what happened the very next weekend, if we pick up where we left off, September 20th, if you took the trade, taking a few minutes on Friday, we always do this on Friday before the market closes, you could have headed out to catch your favorite team playing on Saturday, then relaxed a bit on Sunday, and came back after the weekend to a beautiful $847 automatically sitting in your account. Then the next weekend, September 27th, placed a quick trade from the phone while playing some golf, and then hit another 1K payday on Monday. This one, $1,048. Again, always closing out by Monday.
Nate, that's great. And I want to stop you right there. Look, guys, the average household has just north of $5,000 a month in expenses. Now, I'm just talking about things like healthcare, food, transportation, clothing, electricity, just the bare necessities. Meanwhile, the average monthly income in the US is actually only $4,340 a month. So here's a question. How can anyone possibly keep up?
Crazy.
Well, right now it's mathematically impossible. It's a huge income gap that many folks can't fill right now. But Nate, your weekend cash flow method could have helped everyday people fill that income gap and then some. I mean, in the month of September alone, those four examples you showed us that happened back to back to back, we're looking at what could have been more than the average Joe brings in a month, $5,667, and more than enough to cover the average monthly expenses. Now, that means the money that you actually worked hard, worked your tail off to earn can actually be used for things that you want to spend it on instead of the pesky bills, or maybe simply building up the rainy day fund, which is a great idea.
Yeah, which is why I've been so excited about this project and that high win rate and everything else, and why I'm on a mission. And today I want to show folks how to unlock a little known income opportunity hidden right inside of what the CBOE did pretty recently so that you can take advantage of this consistent weekend cash flow right away, starting literally today. And based on my research, you won't be able to target these types of steady returns literally anywhere else. Now, most financial advisors or local finance gurus in your town might lead you to think that the only way to hit your retirement goal is to stash money away into the S&P or mutual fund and just simply hope that it grows enough, quick enough to help you retire. But unfortunately, that is not getting the job done anymore. If you do the math at 6% annually, it would take about 41 years for $100,000 to turn into $1 million. Most people I talk to don't have 41 years to hang out and wait, not dipping into that. And a recent study by Citizens Bank suggested you'll actually need a lot more than just $1 million. In fact, with the ever rising cost of living, they suggest having at least $1.8 million to retire comfortably. And new studies are actually coming out saying that's not enough anymore just in the last 2 years, which makes it, now you need 2 or 3 times the amount of money to hit that goal, which is why millions of people, young and old, have been forced to delay their retirement. This one said 40% of older Americans pushing back. That doesn't even include the regular people who are realizing that they're going to have to start pushing back as well. So forget about retiring at 65. Far too many folks will be working well into their 70s under this new rising cost scenario that we find ourselves in, which is why, whether you're retired or just starting, looking to plan your retirement, you need to pay attention because with the weekend cash flow, you have an opportunity to help fill that gap, accelerate that curve, targeting extra income over the weekend while most folks are left without a way to earn anything from the market on Saturday and Sunday. And so far, the results from our study are absolutely outstanding with the success rate well north of 90%, which is like cashing out on over 9 out of 10 trades that you put on over the weekend, which means we can target income regardless if the stock market goes up, down, or flat. And yes, I really mean that. Let's take the first weekend of December, for example. So the market ended up flat over the weekend, but the weekend cash flow would have made $1,929 over that first weekend. And then the next weekend, the markets went up. Weekend cash flow would have made about $775 in weekend number 2. And each weekend, we have the same opportunity. Like over the next weekend, when the stock market actually fell out of bed, you still could have collected $1,039 $37. Pretty darn nice payout when the market is churning down over the weekend. As I'll show you, thanks to a very special type of trade over the weekend, we're able to collect even if the trade goes slightly against us. Like I
Well,
just
Nate, in
showed
the
you, by the
case
way, in
of
that
these,
training.
yeah, in the case of these December examples alone, we're looking at a chance to pocket extra income over the weekend, regardless of what happened. And keep in mind, folks, you could have spent the weekends doing the things you love, just like Nate does. You don't have to be glued to the screen. The markets are closed. Now, maybe that means taking your kids or grandkids to the ballpark or checking out some national parks over the weekend. Or maybe that means coming down to one of Nate's world-class coaching sessions to hang out with other awesome traders just like you for the weekend. Now, however you want to spend your weekend, that's your choice. Knowing that Monday has just become your new favorite day of the week. So, Nate, it's time to spill the beans. What's making this all possible?
Well, it's really thanks to the CBOE and the special perk that they set up in that newest ruling pretty recently. In fact, up until that announcement, this weekend cash flow opportunity quite literally was not possible. It wasn't even available to anyone except for maybe some institutional trader who had inside access. But now they've unlocked it for the everyday Joe, and it's for years and years and years to come. What the CBOE did was they launched daily options. Okay. But they only launched them on a few tickers that we can use. I'm sure you guys are familiar with some of them. And we can now use those tickers to target income over the weekend. And don't worry, if you guys have never traded those, they're already available in every regular brokerage account. Now, these daily options allow us to specifically target income over the weekend because we can close out on Monday. And if everything works out, we have a chance to target about $1,030 on average by the time Monday rolls around. Just like the first weekend of the new year, all you would have needed to do was set your trade on Friday, January 3rd, before the market closed for the weekend. Sure enough, by the time Monday hit and the cash settled, another $2,807 winner in the books. And don't worry, placing a trade with the weekend cash flow method is no different than trading Apple or Amazon or anything else.
That's really awesome. And Nate, I'm really starting to fall in love with this strategy. I mean, this weekend income seems so predictable. You just showed us working up, down, and flat markets. So some people may be wondering, Nate, can you even lose?
Well, yeah, obviously, yes, you can lose. No strategy wins all the time. You should never risk more than you can afford. All that good stuff still applies. But my goal is to do everything in my power to help limit losses. After all, I'm putting my own money onto these trades, and I certainly don't want to take a single more loss than I need to, which is why my team and I worked very hard trying to perfect this method for both good and bad market environments. Now, I'm happy to report after analyzing over 2 years of data, the final study shows we are very small account friendly, about 180 bucks on average for the trade. Now, $1,030 is the average weekend payout based on the 5K stake that I use for all of our examples, and a 94.8% success rate, which is just insane. And by the way, it's not open-ended risk. You have a built-in risk management defined risk strategy on every single trade.
Nate, those are some remarkable results. I think we can all agree with that. But you're being a little too humble. You forgot to mention that so far in the live publicly shared trades, you're actually undefeated. And folks following along with the weekend cash flow method are absolutely loving it. Here's Dan who says, I love that the S&P doesn't have to be positive for the trade to work. I'm 4-0 on the weekend trades. Thank you for your input. Steve here said 2 tries, 2 wins, about 900 bucks in profit for him. Linda, look at how hands-free this is. Perfect. Went in with $350 and it closed automatically while I was prepping lunches for the kids. It is simple and perfect. Thank you. Emery here said traded 30 contracts and netted $1,629 over the weekend. And Carrie says keep up the great work. $1,700 over the weekend. So Nate, tell us, how does it really work?
Okay, well, first you need to understand when most people think of the word options, they think of buying options like we were talking about earlier. But instead of just buying options outright like most people do, I use a special type of trade on these daily options to collect premiums on other people's risky bets. And no, we're not doing naked options like I said. Think about all the massive insurance companies like Allstate or Progressive, one of our favorite stocks. They just sit back and collect insurance on folks month after month. We're doing the same kind of thing, but in the stock market, taking a weekend paycheck by collecting premiums on other folks' options bets time and time again. But the way I collect these premiums in the stock market is very unique. You see, when the CBOE listed these daily options, they calculate a standard amount of premium for each day. If you're entering on Monday, collecting income from Tuesday, you're going to get 1 day worth of premium. If you go Tuesday and you're looking to collect money on Wednesday, you're going to get 1 day worth of premium, so on and so forth. Now, most people do this because it's easy and simple. but they don't realize how much money they could be leaving on the table because, frankly, there's a better and safer way to do it. And by entering before the weekend on Friday and collecting income from the Monday options, we get bonus premiums just by holding it over the weekend. That's like instantly tripling the amount of premium collected. And get this, because the market is closed on Saturday and Sunday, we're actually able to sidestep a lot of the market action, but still get paid for all 3 days. Just like what happened back on January 10th. You could have spent your week staring at charts, banging your head against the brick wall, hoping to find an edge, or you could have taken about 2 minutes of your time, placed a special type of trade on Friday, collect those bonus premiums over the weekend, then gone out and hopefully actually enjoyed some of your time over the weekend. And sure enough, while folks invest in the S&P 500 lost money over the weekend, with the weekend cash flow method, you could have pocketed $1,057 over that very same weekend. Now, of course, you can't just go out and blindly pick options to make this happen. If that were the case, I think everyone would have figured it out by now. You got to know which trades to place on Friday to collect that income. And I'm going to share everything you need to know to start collecting your very own weekend cash flow right away. Because right now, everyone could use some extra cash flow. I think we can all agree on that. Doesn't matter where you live, what kind of brokerage account you have, who you trade with, retirement account, whatever, doesn't matter. It doesn't matter if you've been trading for decades or if you're just getting started. I've put together a step-by-step workshop that shows you exactly how you can start targeting these payouts with weekend options. It includes full details from how to place your trades, how to upgrade your account for options, how to manage your risk so that you can start using this technique in your account literally today. And I'd like to invite you to access this workshop right now today. It's on demand, ready for you to view right now so that you can start taking advantage of weekend cash flow right away. Once you get your hands on this step-by-step video course, I think you'll be shocked at how clear-cut it really is. You'll immediately be able to start using it every weekend, including this very weekend, just like folks could have on February 21st. After just hitting a few buttons, you could have the trade locked and loaded, ready to go for the weekend. Just select the trade, send it off, and back to your normal day. And sure enough, by the time Monday hit, the weekend cash flow could have paid, once again, $1,491 in February. Of course, any regular brokerage account will do the trick.
Yep, that's
and by
right,
the
guys.
way, the fact that the government even allows this strategy to be used retirement accounts shows you that it is risk defined. It's risk control. We don't have that open-ended risk open on any of these weekends.
Nate, I love it. And I have to tell you, this weekend cash flow method is something that I definitely want to start trying right away. In fact, I've been taking some of the trades and enjoying that 100% win rate so far. And so far, the stories from your students following along, nothing short of remarkable. Look at this. Mike P said taking 3 trades, all winners. Doug here said taking both trades since joining. He's made $1,090. Ifasa says low risk, high reward. Have taken all 3 of the weekend options trade and been profitable in all. Thanks. Kurt says been a subscriber for 3 weeks. He's got 4 trades in and 4 winners under his belt. Craig here said started with 3,000 and now his balance is at $7,480 for
That's
the month.
awesome, Craig.
He's up
Absolutely crushing it.
$4,400 in a month.
That's, yeah. And those really are amazing stories. I mean, I love hearing from Craig, Kurt, Doug, and a whole bunch. I think we ended up having over like 250 people who actually sent responses. And so it's awesome to see those people taking advantage of that extra cash flow over the weekend. And that's why I agreed to sit down, do this today, open it up again, and try to get as many more people on board as possible and show them how to start using the weekend cash flow method to help boost their income. So today, you can claim access to this workshop, start implementing this strategy in your own account just by subscribing to the exclusive weekend income service, Weekend Options. This service is solely dedicated to targeting extra income over the weekend, thanks to that special perk we talked about by the CBOE just literally months ago, I guess a couple years ago now, but most people not taking advantage of that yet. One that's shown the power to pay $1,030 on average in extra income each weekend we get an opportunity. So today, I'm hoping to bring on 50 new people before our trade triggers literally in a few hours, whether you've been investing for years or just getting started. Every single week, I'm going to give you my best weekend opportunity, one that I personally recommend to my closest friends, one that I take with my own money, and each one is based on the same method that study shows could have paid $1,030 on average each weekend there's a setup. And I'll hold nothing back. In each weekend options alert, I'm going to break it down for you step by step. The ticker, when to place the trade, the options criteria, entry and exit. It is all in there, folks. Each income alert will have clear instructions on how to place the trade. I do all the hard work. I'm trading these myself. I do all the heavy lifting. I package it up and send you the opportunity on a silver platter. You just read each alert and follow along if you choose. Just like what would have happened the very next weekend, February 28th. I would have sent the trade alert right to your inbox. You would have taken the trade. You could have spent your weekend, working on your short game, which I desperately, desperately need to do. Maybe practicing for the next pickleball tournament. We also built a pickleball court in our backyard, so I got to work on that as well. Lots of hobbies to work on over here, Graham. And by the time Monday hit, an extra $929 sitting in your account, again, without doing anything at all. And don't feel like you need to be sitting next to your computer all day long. I post the trades each Friday right around 3 p.m. so you always know when to check for the next alert. I want your experience with weekend options to be as hands-free as possible. Of course, alongside the email alerts, I'll also be including cell phone alerts and Telegram alerts. So while you're out and about, you can still take advantage of weekend options. And to make it even better, you also can take advantage of the extended hours. Okay, so this method is actually designed to specifically focus on tickers that allow us to have some extra time in the market after the regular market hours close. And in our members area class, I'll walk you through the specifics, plus how you can enter up to 15 minutes after the closing bell, thanks to a small tweak in our options.
Well, Nate, I love how easy you've made this for the new members today. And your students love how hands-free these opportunities really are. Here's what one of your top members, Drew, said about it. Love the worry-free, good to cancel targets for double-digit singles versus anxiety-producing swings for the fences. I do like having that set time to look at that recommendation. Boy, does that make it easy. Greg G, who's been enjoying the 100% win rate so far, says, I love how clear your instructions are. It's easy to follow. And just by looking at the performance so far, I think it's worth its weight in gold. I mean, the strategy is so good that it hasn't seen a loser in over 6 months, and it's not like you're going for measly returns here. Folks, just look at how some of these months have stacked up. $2,320 in income in November, $3,743 in December, $5,667 in January, $5,000 in February as well. No losers across that period. And for the more recent trades, the ones that you've been sharing publicly with the members, well, you've kept that perfect win streak going. So guys, this isn't like missing out on Amazon in 1999. These opportunities just happened. So Nate, I have to know, will the new membership cost around $5,000 per year?
Well, I do believe it's worth whatever we put on. I mean, like you said, the profit factor and the win rate is insane. So it's probably worth whatever price we put on it. But before we talk price, I do want to highlight maybe one of the biggest benefits of being a member of Weekend Options. Something that I haven't really talked about today, but it takes Weekend Options to a whole new level. While we normally target extra income over the weekend, closing out on Monday, sometimes the trade is so good, we actually get paid before the weekend even hits. Like what would happen on Friday, May 31st. It would actually hit before the trade triggered. Or July 28th, $909 before the weekend even started, you would have had your money. Or Friday, March 7th, $943, you would have had your money on the sidelines before the weekend even started. Imagine that. Imagine going into the weekend, hoping to make money over the weekend, but instead you already have $943 cash in hand before the weekend even starts. And some of you in here don't even have to imagine. You actually experienced it recently, like Doug or Buck or Aaron or Drew or Bob or Ken or several others, Nick, who actually took the trade on Friday, set their target, waiting for it to cash out on Monday, and it actually hit on Friday before the weekend even started. Now, for anyone out there who would have loved to head into the weekend with an extra $943 in your pocket, well, I do have another special piece of the puzzle for you, which is the early payday plan. Inside the special briefing, I'm going to show you how to set your target so the trade will automatically close as soon as we've hit our goal. That way, you can set the trade, close your computer, walk away, and enjoy life. I'll even include exclusive information on how to automatically help protect against downside risk as well.
Well, Nate, I have to admit, this membership is really special, and your students have been loving these results that they're seeing from the trade so far. Here's Aaron, made $813 over the weekend. Bill cashed in with $957. Cody did a little better. He said easy to follow, $1,140 on that weekend trade. And Jeff, who's hitting it out of the park, he uses your weekend options, and he's up $7,800.
Yeah, obviously remarkable stories. And regardless of how good the research results are and how great those testimonials are, not every trade is going to work out. Same thing here on today's trade. You should never risk more than you can afford to lose on a single trade. And luckily, you don't have to, because the average trade is about 130 to 150 bucks. And if you're starting small, that's okay. You can scale up over time. Whether you're starting with $1,000 or $1 million, I want you to focus on the training, understanding the process, and building it up weekend by weekend. Getting the hang of these straightforward weekend option opportunities, you can always start small and scale over time. And that's why it doesn't matter who you are, young or old, if you've been trading for 10 years or just a few months. Today, I want to invite you from all walks of life to be one of our next 50 members to jump into the weekend options program. And based on the last 4 trades we've taken, which would have happened, basically in a 1 month span there, 781, 1031, 1849, 869. I'd say this exclusive membership is worth, $7,500 a year. You basically would have paid that off in your first 6 weeks. But for new members today, it's not going to run you anything close to that. Today, I'm hoping to bring in around 52 members for a steep discounted price, get you in today before our trade to unlock the full potential of these weekend options. With a new opportunity coming to your inbox every Friday, just before the weekend hits, you take full advantage.
Nate, the timing for this is perfect. I mean, perfect day for a new trade. I love it. And I bet these spots are going to fill up fast today. So, what is the price? Maybe $5,000 for the year?
You can forget about paying 5 grand or forget about even paying 4,000. In fact, if you join, ask my team to set the price for $29.93 per year. I think that's what it is on the website right now. But if you are watching the webinar, you will get an even better deal. You see, after analyzing 100 trade opportunities across all different market conditions, I am absolutely blown